Continuing to go up today, and affordability is just crumbling in Canada, and I have the hiccups. So, welcome to Canadian Mortgage Weekly, episode 145. Really excited to share with you some of the just thoughts I have today on affordability and how rising interest rates are impacting affordability in a very negative way in Canada, especially now that rates have gone up again on June 7th. It's quite amazing, actually, how much affordability has crumbled just in the last few weeks since rates have risen on June 7th. I cannot even believe it, and I'll be going into that today. Just to let you know a little bit about myself, I'm a mortgage broker with 13 years experience. I do have hiccups today, so uh, apologize about that. But affordability is crumbling, and I'm going to go into that right now just to give you an idea of how it's being affected in Canada with rising interest rates. One thing I've noticed is it's pretty much impossible for a single person to buy a home anymore. If you're a single parent living with a couple kids, you're typically making your annual income from your job, and as well, you're making an annual income from Canada Child Benefits. And those two incomes together can be used to qualify you for a mortgage in Canada. And what I'm noticing is that that's just not enough to be able to get you into a home. Maybe you have child and spousal support coming in as well. And this, in addition to the Canada Child Benefit and in addition to the uh, income that you're earning from your job, is just not enough these days. I was actually looking at my calculator here before the episode started to give you some information about how this all works, because just a few years ago, if you made an income of $60,000, this was just before the pandemic, you made an income of $60,000, you could buy a home on your own very easily in Ontario, Canada, where the province that I do mortgages for the last 13 years, that's where I'm based out of. And I would see people buy a home if they had a $60,000 income on their own for about $400,000. It was very common, and interest rates were low, and there was no stress test, and the TDS GDS lending ratios were just a lot more lenient back then. Now what I'm seeing is that those same people, whether it's the person that bought before and now is looking to move because they want a different house in a different location, they can't afford it because they need to requalify. And with these new interest rates and new stress tests, it's really difficult to requalify on your own and get into that same house in a different location. If you need to move, you're pretty much stuck in that location. And if you're looking to buy a house elsewhere, if you're getting into the market with a $60,000 income, you really can't find anything. So I was just putting in today's interest rate, $60,000 income, says that the housing affordability is 203,000. Can you believe that? With a $60,000 income, you could afford a $400,000 home just 3-4 years ago. Now it's 203,000. I do apologize about my hiccups. Can't do anything about it. It's episode time. Let's get it done. But 203,000, that is quite a drop, quite a crumble actually from the 400,000 that I just saw a few years ago. Those people that bought homes just a few years ago, they're now stuck in those homes, and if they can't afford to move, they're stuck there. If they got a new job elsewhere, they actually need to sell and give up home ownership, move into a rental now, going for because they can no longer afford a home on that same income. So let's take a look at, if you are a single person making $60,000 a year, you have two kids, so you're making a Canada Child Benefit income of about $800 a month. So we'll add that to your income as well. And maybe you have spousal support and child support of, say, $15,000 a year, which works out to just over $1,000 a month of child and spousal support. So if we add all that in here, how much home can you afford based on that income? 60,000 salary plus 15,000 in spousal child support and $800 a month in Canada child benefit. Well, your affordability is only $300,000 in terms of a house. Can really that buy you anything in one of the major cities in Ontario, Canada? It really can't. And it's really sad because the average national house price now, it's exceeding $729,000. And the houses that I'm seeing in my area, my specific local area that I'm in, I'm based out of Aurelia, Ontario. And I specifically have my local market as Aurelia, Barrie, Midland, um, uh, Bradford, Innisfil, and down to Toronto there. You really can't buy a home for $300,000 in that market. The cheapest home you can really buy is around $450,000. And even if you're looking for a home in that price range, they're going like that. They're going like that, right? And when they're going like that, you also have to remember these homes. I mean, I just did a mortgage for someone that bought a home in this price range. It needs a lot of work. It's dated. Sometimes renovations are kind of, people beforehand have torn things apart, and it just needs a lot of renovations to be completed. They're just not homes that aren't in a good position. And if you have an income of that, say $60,000 for your own personal income, and $800 a month Canada child benefit, and another $15,000 a year coming in for spousal support and child support, you really can't afford to put all this extra money into fixing the home, let alone buying the home. It's just, you're not going to be able to get into that, especially if you don't have the ability to do work yourself and you have to hire it out. Because when you hire the work out, you can have all that extra cost to keep that home in good repair. So, if you're just joining me now, we're talking about housing affordability, and I have the hiccups. So, with housing affordability, I was talking about how just a few years ago, just before COVID, if you had a $60,000 income, you could buy a home of approximately $400,000, no problem. There was no stress test, rates were lower, and the lending requirements were just a lot different back then versus now. They've made it way more harder. 𝗍𝗓𝘃 has introduced guidelines like the stress test to make it much more difficult to qualify for a home. And the stress test is still happening. So I put in the calculator today. $60,000 gets you $200,000 of a mortgage in home, actually. That's mortgage plus home. So $200,000 home can't really be found in Ontario. I think the only place you could probably find a $200,000 home is if you go north up to Dresden, Ontario. That's near Manitoba. There's not really much there. If you're from Dresden, I'm not making fun of you, but if you're from Dresden, I've been there. There's a gas station and a convenience store. That's great. But maybe you could find a home up there. But if you're working and making $60,000 a year, that's a decent salary for the most part. You're going to need to live in a center, like a city in Ontario. So, with housing affordability at this state, what do you guys think are the answers, right? What are the answers for a single person to get into their own home? Well, they have to rent. There's really no uh, other option. I mean, maybe you can live with family, uncle, aunt, grandparents, parents, but a lot of people, they don't have that option anymore. Maybe their family has passed on, or it's just the family's not close because of work. You're kind of stuck renting in that situation, and even rentals are getting higher in cost and costing more money, so much so that it's getting prohibitive to find housing in that market. All right, so let's take a look here at how much affordability has been impacted by the most recent interest rate hike. All right, so say if we look at the last interest rate hike, that was June 7th, it went up 25 basis points. So if you're looking at getting a mortgage before the interest rate hike versus after, all right, oh nine, So actually can afford it bumped your affordability down by an average of $17,000. I actually had a specific scenario where a client was wanting to get into a pre-approval so they could start looking for a home, right? And they already are in a situation where what they're going to be able to afford is barely what is out there on the market. So they were waiting on getting documents into me, and they didn't get their documents in on time before the rates went up. And after we did get the documents, the change in uh, affordability was $17,000 difference. And that $17,000 simply was the cost that that person had to deal with because of getting their documents in late. So when a mortgage broker, mortgage professional, mortgage specialist tells you to get your documents in on time because it's really a big deal to help you get into a pre-approval, it's actually a big deal. I really couldn't finish that pre-approval until I had a few of those documents in place. And that cost them $17,000. I couldn't believe it how much of an impact it had, especially when they're looking for a home. And what ended up happening because of that 17,000 is, and keep in mind, I do have the hiccup, so I apologize. One of those things they have to do is lower their search criteria, and it's even now much more harder to find a home. I can't believe where the housing market is today. I'm actually doing some other videos that I release on TikTok here on my channels. Make sure you follow. I'll be talking about how these days to buy an average price home, you really need to have four people on title with you, four people that are working, making an income. And I'm seeing this quite regularly now. So, why do I say four people specifically? Well, if you look at what it takes to get into an average price home, if you have no debt at all, you need about $150,000 income to $160,000 income. But say you do have a little bit of debt, you're really going to need to have a higher income. So say you're going to need $180,000 to get into an average price home. If you divide that by four, that's an average of $45,000 salary for each person. So having four people on title can get you to the $180,000 income that you need to get into that home. Now, what am I seeing in terms of these four different individuals? How are they comprised? Who's buying their home together? Well, you can have a couple and another couple. They connect and they buy a home together and they just live in separate areas of the home. It may not be a duplex, so to speak, or a home with two units, but they share the home. They divvy up the space in the accordance to the way they want to do it. I'm seeing a lot of this actually, just so people can get into a home. Two different couples, they buy together and they get into the market. They live together for a number of years. And then when they want to build their family, one buys the other one out, or they both sell and they both go their separate ways with the equity that they have. That is one major route people are taking to get into the market today. What other ways am I seeing? Well, you have the young couple, and then you have the parents of one of the couples, or maybe a mom from one and then mom from the other, or something like that. And then you have four different incomes going on that mortgage. Two are co-signers, two are living in the house. And that's another way people are getting into the home. And I'm doing one of those mortgages right now where the folks that got pre-approved, they could only get pre-approved for X amount, but they needed to go up an additional $50,000 just to find something in their price range. So they had to actually add two more people on title because adding one person wasn't enough. They actually had to add two people with the stress test and everything that is involved in mortgages. It really pushed qualifying to the absolute limit. So that's another way four people are going on title. You got a couple and the co-signers. So have you guys been in a similar situation? Has anyone watching bought a house with four people on title? You might be thinking, is that a permanent thing? Do I need to keep all four people on title? Can I remove my co-signers down the road? Well, you can actually. You can do what's called a temporary co-signer. And a temporary co-signer was really popular with first-time home buyers, especially last couple of years, because it allows them to get into the market, stop paying rent, and build equity. And it essentially allows a parent or uncle or grandparents that have a pension income to co-sign on the loan. They don't have to live in the home, but essentially can add $100,000 to $200,000 in affordability to get into the market. And then after a few years, say 2 or 3 years, you've built some equity. Number one. Number two, you've actually even maybe even gotten a raise at your job in those 2, 3 years, most likely, which means you're making more money. And number three, you have a mortgage now on your credit bureau. Um, the lenders can see that you've had a mortgage, that you're established, and that gives you a little bit more ability to remove the cosigner at that 3-year mark. And we can actually do that midterm. So say if you're locked in for a 5-year fixed mortgage or a 10-year fixed mortgage, you can actually remove the cosigners midterm. And that's just a legal fee. I have the hiccups, so apologize about that. But it's just a legal fee to remove the cosigners, and we can redo the paperwork that way. I actually have a client right now that is in that situation. They added 2 cosigners to her mortgage because she was a single person moving into the condo. And now she's able to afford the condo on her own, and we're going to be removing those 2 cosigners. And she's got her own place. Now, a lot of people don't like to use a cosigner because they want to buy the home on their own. They don't want to have their financials shared with everyone else. And I understand that. But these days, when you're getting into a home, you almost need to do that just to be able to get into the market. As I mentioned, housing affordability has really crumbled. Just 3-4 years ago, I was doing mortgages for people that had a $60,000 income, and they could get into a $400,000 home. And these days, that same person, same everything, other than the rates today and stress tests that have been introduced and everything, you're looking at a $200,000 maximum purchase price. Quite crazy. Excuse me for my hiccups. So that's how interest rates are actually drying up affordability. As rates go up, affordability goes down. Every time rates go up by a quarter point, you're actually losing about $17,000 in affordability. So what's going to happen on July on their next rate announcement? I think it's July the 12th. July 12th, we could see the Bank of Canada raise rates by another quarter point. And when Bank of Canada does raise the rates by another quarter point, we could actually see affordability drop by another $17,000. And every time affordability drops, it just means that many more people need to get on that mortgage for that couple to buy a home. As I'm mentioning right now, we need about 4 people on title to buy a home. It's no longer just the husband and wife or boyfriend, girlfriend, or the couple, 2 partners that are coming in together. It's the 2 partners, and then you have 2 cosigners or 2 families that are getting together and they're buying a home and sharing it that way. If you don't like it, I don't like it either. It's a lot more work for a mortgage professional to bring that much information together, but I've been in this for 13 years and I don't mind. So if you're looking for a pre-approval, you know where my contact information is. I would love to help you with all that. And with that, I did want to get into a little bit of what's happening in the market today to give you an update of what's happening with mortgages and where I think rates are headed in the next few weeks. Well, with that, I did see that the Canadian national house price average has gone up yet again. We are up to $729,044. Specifically, if you're looking at the average house price in, say, Hamilton, Ontario, it's $814,000. Average house price in London, Ontario, $682,000. But the cheapest city in Canada so far is winning at $379,000, which is Winnipeg. If you're looking to buy a house, move to Winnipeg if you can't, because Winnipeg has the cheapest houses right now. And with that, Toronto is sitting at $1.196 million. So quite a big price difference across the big cities in Ontario and Canada itself. What's happening with Canadian inflation? Well, as we saw in April of 2023, it did go up 0.1% to 4.4%. That is an increase of 0.1% from the prior month, which was 4.3%. And I've been waiting for inflation numbers to come out for May for the last little while. And usually inflation numbers come out at the middle of the month. For example, May 16th, we saw inflation numbers released for the prior month. April 18th, we saw inflation numbers released for the prior month before that. And we're not actually expected to see Canadian inflation numbers until June 27th. Excuse me for my hiccups. So we won't be able to see what Canadian inflation is month over month until June 27th. So we'll have to wait to see what's happening there. Let's see here. All right. And what else is happening for inflation? Well, we saw the United States inflation dropped from 4.9% to 4% in May of 2023. A nice big drop there. And as we saw, coincidentally, the US Fed paused interest rates hikes for the time being, and we'll see where they go going forward. But that's good news for the States. What's happening with the CDOR rate in Canada? Well, the CDOR rate is a metric that I use to measure the competitiveness of a variable rate mortgage. As I know, being in a variable rate mortgage myself, I want to go on record saying that I regret not locking in, despite what my gut was telling me. I was going off historical data and colleagues in my industry. Stay variable. It's flexible. It's the way to do it. But I regret not locking in, looking back at it now. And, that's okay. I make mistakes as well. I've only been in the industry for 13 years. If I was in the industry maybe in the 80s as well, I maybe would have a different perspective, even though I've heard it a bunch of times. So CDOR rate currently has been rising to 5.34%, which is interesting because it was staying at 5% since about January of this year. And then I've only seen that increase since about the beginning of June, actually, since the Bank of Canada raised its rates. So it's gone up from 5.04 to 5.34%. So what I do is I measure the variance that the CDOR rate has to prime rate, and prime rate being at 6.95%, CDOR rate at 5.35, the variance is 1.6%. So if it's under 2%, that the competitiveness for the variable is just not there. So if you are considering variable, I would make sure that you talk to your mortgage professional or mortgage broker to get an idea of if it's really right for you. It does come with flexibility, but it also comes with its caveat. For example, I just had a 5-year fixed rate client call me 8 months into their new mortgage that they just locked in for 5 years, wanting to break that mortgage. Well, fixed rate mortgages have a much higher penalty than variable rates. For example, variable rate mortgages, 3 months interest. But for this specific mortgage, 5-year fixed, the penalty, you'll never guess it, $63,000 to break that mortgage, to lock in for 5 years. $63,000. Wow. What a big penalty. So obviously fixed rates do come with their safety and conservativeness, but they also come with larger penalties. And because of that, if you do need to sell early, you could be stuck paying a penalty that is just so much higher. In this case, $63,000 was the lender. In this case, the lender estimate for the fixed rate penalty. All right, let's look at employment in Canada. Usually, if employment is going up, it means the economy is doing really well. And in this case, employment has been going up for the last few months. But just last month, we saw unemployment go up and jobs not go up. So we had 34,800 less jobs in April. And I actually think that's a great thing for those who are concerned about interest rates, because if jobs continue to go on the decrease and we continue to see higher unemployment, we will see lower rates eventually, but maybe not in the short term, because the government's not really going to allow a higher unemployment. They need that employment to continue. So we'll see what happens with the unemployment rate next month. We'll have to watch that. We'll see the numbers probably early June, maybe June, not June, early July, July 10th or so. And we'll see if this trend has continued. But we have so far 1 month of higher unemployment. All right. And the 5-year Canadian bond yield, I use actually this specific metric to follow fixed rate mortgages. And 5-year Canadian bond yield is higher yet again. We're sitting at 3.857% as of 11:55 a.m. on June 22nd. Looking at it over the last year, this is probably, is this the highest it's been? It's the highest it's, well, it was about this high between October and November of 2022. It hasn't been so high since then. And with that, it's approaching that same high now, between November and October of 2022. Do we think that the prime rates, not the prime rate, the 5-year bond yield will continue to rise? Well, there's a lot of things that are adding to that. National average Canadian house prices rising. We're seeing inflation, the most recent month inflation in Canada rise. We're seeing the Bank of Canada raise interest rates on June 7th. So that factors into people thinking, we need to put more money into bonds, and it causes the bond yield to go up. So with that, we're still seeing the bond yield high and no end in sight. And what's happening on my side is every time I log in the morning, I'm seeing lenders coming out with, we have a higher fixed rate now. We are raising rates again at midnight. Get your files in before rates rise. Rates gone up again. And because rates are going up so much, it's again crushing affordability. Every time fixed rates go up by a quarter point, it's a $17,000 average decrease on your mortgage affordability. It's quite insane. And with the bond yield, where it was at just last month, it was at 2.87%. So about 1% lower. So just last month, I was able to pre-approve buyers at a fixed rate that was about 1% lower. So even though variable rates have only gone up 0.25%, the real losers here have been those who want to get a fixed rate and didn't lock in their pre-approval before fixed rates went up. And just to let you guys all know how pre-approvals work, when you get a pre-approval, and a lot of clients did last month when fixed rates were a lot lower by about a percentage point, they can actually lock in that rate for 4 months while they look for a home. And if rates continue to go up, they are still locked in at that lower rate, and they're able to shop for a home at that lower rate, meaning that their affordability is still just as good as when it was when the rates were lower. And to give you an impact of how much the fixed rates going up have impacted affordability, fixed rates have gone up about a full percentage point now since last month. And I was mentioning it's $17,000 affordability deduction for every 0.25%. So if you're looking at a full percentage point, you're looking at an affordability reduction of about $70,000 last month to this month. What is that going to do to the housing market? Well, just think about it. If people can afford $70,000 less home, it's going to push new buyers out of the market even more so. And existing buyers or existing homeowners that are selling their home, they'll have to sell their home for more money to get into that other home. So it's going to keep people in their houses longer, or it's going to force them to price their houses at a higher price. And it's just making that whole housing market that much more unattainable for the first-time home buyer, that much more heavier to qualify for. As I mentioned earlier on my show here today, you need about 4 income earners to go on title for a mortgage these days. And what I'm seeing a lot of is a couple with another couple buying a home together and sharing the living space, and they all have full-time jobs, or you have a couple and their parents that are also having full-time jobs, and they're co-signing just to allow their kids to buy a home. So typically what I'm seeing is 4 people on title. That's a very common thing. I'm seeing more so this year than ever before. And if you're looking to buy a home in Canada, having 4 people on title is the easiest and most solid way to go without any affordability blocks going that direction. All right. And with that, okay, so we covered bond yield, fixed rates, inflation, house price, variable rates, the job market, and all that. I know that we're covering a lot here today. If you have any questions, I would love to hear from you. My name is 𝗪𝗠𝗘𝗦𝗧. I've been in the industry now for 13 years. I really help people get into their homes. I've been working a lot with first-time home buyers. And just to give you one last final thought here, first-time home buyers, the way they're getting into the market right now and the way they're scrounging up the down payment and being able to afford this mortgage is, well, to save money, it's really hard, but they will live in their parents' home until their mid-30s. If they have a partner, the partner moves in with them, they live rent-free, they are able to save money very quickly that way. But at the same time, saving money quickly doesn't still amount to a down payment. You need to be able to save $30,000, $40,000 these days just to get into a home. So to be able to save that, you need to kind of live in your parents' house for about 2 years minimum for most people to save that amount of money. And then even when you have enough money to buy that home, the income you need to buy a average price home is around $180,000 these days. So what I'm seeing is that those 2 folks don't really have $180,000 to buy that home. You need 4 incomes, right? Because the average income is about 45, 50,000. You need about 4 incomes to get into that home. And then those incomes coming from either 2 couples buying a home together or a couple with the parents co-signing, and they go on it that way. And that's how people are getting into the market for the most part. Also, we're seeing a lot of folks that are new to Canada, just gotten their work permit, work visas, or permanent residency. And a lot of those folks, they are actually buying as a whole family together. You got son, daughter, they both work, mother, father, they both work. And even sometimes you got 2 more people on title for a total of 6 people on title. With grandpa, grandma, they are also working maybe a part-time job. But those 6 people, and they are getting themselves into a home with a separate apartment so they can all have their own living spaces, because it's much cheaper for everyone to live together right now than it is for everyone to buy a separate home like it was just a few years ago. So anyway, that's my rant for today. Thanks for watching Canadian Mortgage Weekly, episode 145, talking about how rising rates are affecting affordability. And as I mentioned, for every quarter point increase, we're seeing affordability drop by about $17,000. Variable rates have risen about a quarter point. Fixed rates have risen about 1% since last month. So a much higher increase on fixed rates this past month than variable rates. So if you're looking at locking in, I would love to help you get locked in and get a pre-approval in place. So if rates do go up, you're all set. You can send me a message on my social media, email, text message, or book an appointment with me in my calendar link below. And we'll see you next week. We'd love to see you on my next podcast. If you want to watch my videos, follow my account. I tend to release one short video each day, either a reel or TikTok or a YouTube short, whatever you like to call it, whatever platform you're watching on. I would love to be able to get that information out to you. And being in the industry now for 13 years, I would love to help you with your mortgage. Other than that, we hope you have a great weekend, and we'll see you next time here on Canadian Mortgage Weekly, Canada's